So welcome everyone to the most consequential Green Shoot session this year. For those that don't know, I'm Pat Patel from Elevandi, and the company that was set up by the MAS to foster an active dialogue between the public and private sectors to ultimately advance fintech in the digital economy. And we do this by connecting people and businesses, connecting ideas, and connecting insights. And today is a great example of what we do, as the key outcomes of this session is to provide clarity and advance the current thinking of crypto innovation and digital assets by bringing together the public and the private sectors. So we are absolutely honored to have MD Ravi Menon in the house to share MAS's position on cryptocurrencies, stablecoins, blockchain, tokenization, and digital assets. And we're going to zone in on the risks and opportunities, shortcomings, and the potential. So innovation and responsibility is at the heart of digital assets. As the special bonus, we have an industry panel which will clarify and advance the thinking in the digital asset space. So it's quite fitting. We have an absolutely large audience with us today. We have around 100 people in the room from the public and private sectors. We have global media, plus we have thousands of people streaming in online from around the world. So without further ado, it's a pleasure to welcome one of the smartest minds in financial services, and he's very humble too, the Managing Director of the Monetary Authority of Singapore, Mr. Ravi Menon.
Thank you, Pat. Don't believe a word he said. Not only about me, but also about whether this is really the most consequential green shoots. Let me state at the outset, there are no new announcements, so some of the media you can switch off. No earth-shattering insights. We're just going to take this opportunity to repeat and clarify what we've said before, and I'll come to why in a while. So thank you all once again for joining us today, and let me start straight away with the elephant in the room. MAS seems to be sending mixed signals when it comes to crypto and digital assets. Okay, you're all too polite to say that, so I will say it. On the one hand, MAS is promoting Singapore as a fintech hub, partnering industry to explore distributed ledger technology and supporting innovation in digital asset use cases. MAS has said it wants to attract leading crypto players to Singapore. On the other hand, MAS has a stringent and lengthy licensing process for those who want to carry out crypto-related services in Singapore. And MAS has also been issuing strong warnings against retail investments in cryptocurrencies and has been taking increasingly stronger measures to restrict retail access to cryptocurrencies. So there have been expressions of confusion and concern by some observers. They point to apparent contradictions in MAS's stance. That although MAS has said that it is excited about the potential to build a crypto or tokenized economy, it also imposes a stringent regime. Some others have lamented that MAS has made a U-turn in its digital asset policies. They say that MAS was once making pro-crypto decisions, but was now being overly cautious and losing its appeal as a global crypto hub. Yet others see MAS as having struck the right balance, that the crypto winter is proving MAS's policies to be right. So what does MAS really want? Well, actually, we know what we want, but I think we need to do a better job of explaining it so that everyone else understands it too. Before I get to that, it's important to be clear about what we are talking about. Public and media attention has tended to focus on cryptocurrencies. But cryptocurrencies are just one part of the entire digital asset ecosystem. To understand the issues more sharply and what the benefits and risks are, and where the benefits and risks are, we need to be clear what the different components of this ecosystem are. So I can understand why there is confusion about cryptocurrencies, blockchains, and digital assets. And people use these terms interchangeably. The inherent complexity of this ecosystem has made it difficult even for MAS to get its messages across. And I can tell you, it's taken weeks and months to prepare for this. It's not easy to explain this. So today we'll try to do a better job of explaining the ecosystem and its different components, and what MAS is actively promoting, what MAS is discouraging, and what are the risks MAS is seeking to manage. My apologies if just the next couple of minutes, 1 to 2 minutes, sound like a tutorial, but it's important that we are clear about the concepts we are dealing with. A good place to start is with digital assets. A digital asset is anything of value whose ownership is represented in a digital or computerized form. Now, this is done through a process called tokenization, which involves using a software program to convert ownership rights over an asset into a digital token. Now, many items can potentially be tokenized. Financial assets like cash and bonds, real assets like artwork and property. Even intangible items can be tokenized, like carbon credits and computing resources. In other words, anything that has value, when tokenized, becomes a digital asset. Now, that is the concept we are most interested in. Now, digital assets are typically deployed then on distributed ledgers that record the ownership and transfer of ownership of these assets. Now, a blockchain is a particular kind of distributed ledger that organizes transaction records into blocks of data which are cryptographically linked together. Now, when deployed on distributed ledgers, digital assets can also be referred to as crypto assets. So now we get the terms. Now, it is this innovative combination of tokenization and distributed ledgers that offers transformative economic potential. It basically allows anything of value to be represented in digital form and to be stored and exchanged on a ledger that keeps an immutable record of all transactions. It is this crypto or digital asset ecosystem that supports use cases which can potentially facilitate more efficient transactions, enhance financial inclusion, and unlock economic value. This digital asset ecosystem is where MAS sees strong potential and is actively promoting. I've not said anything yet about cryptocurrencies, so let me come to that right now. Now, a cryptocurrency is the digital asset issued by the distributed ledger protocol. It is often referred to as the distributed ledger's native currency, used as a medium of exchange and store of value within the network. For example, to pay transaction fees or incentivize users to keep the network secure. But cryptocurrencies have taken a life of their own outside the distributed ledger. And this is the source of the crypto world's problems. Cryptocurrencies are actively traded, that's okay, and heavily speculated upon, that's not okay, with prices that have nothing to do with their underlying economic value related to their use on the distributed ledger. The extreme price volatility of cryptocurrencies rules them out as a viable form of money or investment asset. It is this speculation in cryptocurrencies that MAS strongly discourages and seeks to restrict. Let me now elaborate on Singapore's strategy to develop a digital asset ecosystem, as well as our regulatory approach to manage the risks of digital assets. Our vision is to build an innovative and responsible digital asset ecosystem in Singapore. And this is a core part of MAS's overall fintech agenda. And as everything else we do in fintech, innovation through industry collaboration is key to growing the digital asset ecosystem. Crypto technologies are promising, and there is great potential to improve financial services. And this is a common goal shared by MAS, the financial industry, and the fintech community. But the only way to find out what works is through experimentation and exploration, learning by doing. We are taking a four-pronged approach to building the digital asset ecosystem. First, to explore the potential of distributed ledger technology in promising use cases. Second, to support the tokenization of financial and real economy assets. Third, to enable digital currency connectivity. And fourth, anchor players with strong value propositions and risk management. The most promising use cases of digital assets in financial services are in cross-border payment and settlement, trade finance, and pre- and post-trade capital market activities. There are several promising developments, including in Singapore. In cross-border payments and settlements, wholesale settlement networks using distributed technologies, such as Partior, a joint venture between DBS, JP Morgan, and Temasek, are achieving reductions in settlement times from days to mere minutes. In trade finance, networks like Contour, which is formed by a group of trade banks, they're establishing common ledgers with traceability to automate document verification, enabling faster financing decisions and lower processing cost. In capital markets, MarketNode, it's a joint venture between SGX and Temasek, is leveraging distributed ledger technology to tokenize assets, which reduces the time needed to clear and settle securities transactions from days to just minutes. These are live examples. The concept of asset tokenization has transformative potential, not unlike securitization some 50 years ago. Tokenization basically enables the monetization of any tangible or intangible asset. It makes it easier to fractionalize an asset or split up its ownership. Tokenization allows the assets to be traded securely and seamlessly without the need for intermediaries. There are already interesting applications in Singapore of tokenization of both financial and real assets. UOB Bank has piloted the issuance of a 600 million Singapore dollar digital bond on MarketNode, MarketNode's servicing platform that facilitates a seamless workflow. OCBC Bank has partnered with Metaverse Green Exchange to develop green financing products using tokenized carbon credits to help companies offset their carbon emissions. MAS itself has launched an initiative called Project Guardian to explore the potential of tokenized real economy and financial assets. The first industry pilot, which is being led by DBS Bank, JP Morgan, SBI Group, and MarketNode, will explore the institutional trading of tokenized bonds and deposits to improve efficiency and liquidity in wholesale funding markets. A digital asset ecosystem needs a medium of exchange to facilitate transactions. The three popular candidates are stablecoins, cryptocurrencies, and central bank digital currencies, or CBDCs. How does MAS view each of them? What's our position on each of them? MAS regards cryptocurrencies as unsuitable for use as money and as highly hazardous for retail investors. Cryptocurrencies lack the three fundamental qualities of money: medium of exchange, store of value, unit of account. And as I mentioned earlier on, cryptocurrencies serve a useful function within a blockchain network to reward the participants who help to validate and maintain the record of transactions on the distributed ledger. But outside a blockchain network, cryptocurrencies do not serve a useful function, except, unfortunately, in many cases, as a vehicle for speculation. Since 2017, MAS has been issuing warnings about the substantial risks of investing in cryptocurrencies. Next, stablecoins. MAS sees good potential in stablecoins, provided they are securely backed by high-quality reserves and well-regulated. Stablecoins are basically tokens whose value is tied to another asset, usually a fiat currency, such as the US dollar. So they seek to combine the credibility that comes from their supposed stability with the benefits of tokenization. And that allows them to be used as payment instruments on distributed ledgers. Stablecoins are beginning to find acceptance outside of the crypto ecosystem. Some firms like MasterCard have integrated popular stablecoins into their payment services. Now, this can be a positive development if stablecoins can make payments cheaper, faster, and safer. But to reap the benefits of stablecoins, regulators must ensure that they are indeed stable. I will talk more about this later. I want to touch on CBDCs. MAS sees good potential in wholesale CBDCs, especially for cross-border payment and settlement. CBDCs are the direct liability of or payment instrument of a central bank. This means that holders of CBDCs have a direct claim on the central bank that has issued them, similar to how physical currency, our cash and notes, work. Wholesale CBDCs are restricted to use by financial institutions. They are akin to the balances which commercial banks place with the central bank today. Wholesale CBDCs on a distributed ledger have the potential to achieve what's called atomic settlement, or the exchange of two linked assets in real time. They have the potential, therefore, to radically transform cross-border payments, which today are, as every one of us knows, slow, expensive, and opaque. MAS does not see a compelling case for retail CBDCs in Singapore. So unlike wholesale CBDCs, retail CBDCs are issued to the general public. In fact, they are like the cash we carry with us, except they're in digital form. The case for a retail CBDC is not compelling for now, given well-functioning payment systems and broad financial inclusion. Retail electronic payment systems in Singapore are fast, efficient, and at zero cost, while a residual amount of cash remains in circulation and is unlikely to disappear. So we all have a fallback. Nevertheless, MAS is building the technology infrastructure that would permit issuance of retail CBDCs should conditions change. MAS has been actively experimenting with digital currency connectivity since 2016. On the international front, MAS is participating in Project Dunbar, which the Bank for International Settlements Innovation Hub is working on out of its Singapore center. The project is exploring a common multi-CBDC platform to enable cheaper, faster, and safer cross-border payments. Domestically, MAS is working with industry on Project Orchid to develop the infrastructure and technical competencies necessary to issue a digital Singapore dollar should there be a need to do so in future. Fourth strategy, MAS seeks to anchor in Singapore crypto players who can add value to our digital asset ecosystem and have strong risk management capabilities. A vibrant digital asset ecosystem will encompass a wide range of value-adding activities. Let me cite 3 examples. JP Morgan has established its digital assets capabilities in Singapore via its Onyx division, which has pioneered several DLT-based products and initiatives. And the offerings include round-the-clock real-time funds transfers with shorter settlement times and no intermediaries. Contour, which I mentioned earlier on, a global trade finance network of banks, corporates, and trade partners. Contour has established its Future of Finance lab in Singapore, and it will conduct research to develop novel digitally native trade finance solutions. Nansen is a Singapore-based company that analyzes more than 100 million blockchain wallet addresses across the world. It provides insights on blockchain network activities and visibility on transacting parties, thereby helping to improve transparency in the digital asset ecosystem globally. Digital asset activities involving payment services must be licensed under the Payment Services Act. We recognize there is some frustration about MAS's licensing process. Some industry players have described it as a slow and tedious ordeal, others as a bugbear for the fast-moving space. Well, given how new the digital asset industry is, it has not been easy for industry players or for MAS. On MAS's side, we need to closely scrutinize license applicants' business models and technologies, and they're all bespoke and different, so that we can better understand the risks before we issue a license. On the part of the applicants, many of them are not familiar with managing the risks of facilitating illicit finance. So MAS engages the applicants very closely to assess their understanding of our rules and also their ability to meet our standards. This takes considerable amount of time, but it is necessary. MAS cannot compromise its due diligence process just to make it easy for digital asset players to get a license. And given the large number of applicants for licenses, we have been prioritizing those who demonstrate strong risk management capabilities and the ability to contribute to the growth of Singapore's fintech and digital asset ecosystem. Like all innovations, digital asset activities pose risks as well as benefits. When digital asset activities took off more than 5 years ago, regulators around the world, including MAS, assessed money laundering and terrorist financing risks as the key areas of concern. But with the rapid growth in scale and complexity of digital asset activities, other risks have surfaced. So regulators around the world, including MAS, are therefore stepping up their responses to these new risks. I will talk about 5 areas of risk in digital assets that MAS's regulatory approach is focusing on. First, to combat money laundering and terrorist financing risks. Second, to manage technology and cyber-related risks. Third, to safeguard against harm to retail investors. Fourth, to uphold the promise of stability in stablecoins. And 5, mitigate potential financial stability risks. The key risk that MAS regulation currently addresses is money laundering and terrorist financing. As users of cryptocurrencies operate through wallet addresses and pseudonyms, cryptocurrencies have made it easier to conduct illicit transactions. The online nature of these transactions adds to the risk. So in 2020, MAS imposed on providers of digital asset services the same anti-money laundering requirements that apply to other financial institutions like banks. And earlier this year, these rules were expanded to Singapore-incorporated entities who are providing digital asset services overseas. Singapore's requirements are consistent with international standards, namely those of the Financial Action Task Force, or FATF. Another risk that MAS has sought to address early on is technology and cyber-related risk. MAS was one of the earliest regulators to impose on digital asset players the same cyber hygiene standards and technology risk management principles that is expected of all other financial institutions. But technology and cyber risks are continually evolving. For example, coding bugs in smart contracts, compromise of digital token wallets or their encryption keys. So MAS is now reviewing measures to manage these and other technology and cyber-related risks, including further requirements to protect customers' digital assets and uplift system availability. And these steps are in line with what other jurisdictions are also considering, including in the EU and in Japan. MAS has since 2017 been reiterating the risks of trading in cryptocurrencies. Prices of cryptocurrencies are highly volatile, driven largely by speculation rather than any underlying economic fundamental. It is very risky for the public to put their monies in such cryptocurrencies, as the perceived valuation of these cryptocurrencies could plummet rapidly when sentiments shift. And we have seen this happen repeatedly. MAS has issued numerous advisories warning consumers that they could potentially lose all the monies that they put into cryptocurrencies. Just take, for example, Luna, the sister token of the so-called stablecoin Terra USD. Luna was at one point worth over $100, but tumbled to zero. MAS has taken early decisive steps to mitigate consumer harm. Since January this year, MAS has restricted digital asset players from promoting cryptocurrency services at public places. So this has led to the dismantling of Bitcoin ATMs and the removal of advertisements on cryptocurrencies in MRT stations. But despite these warnings and measures, surveys show that consumers are increasingly trading in cryptocurrencies. This appears to be a global phenomenon, not just in Singapore. Many consumers are still enticed by the prospect of sharp price increases in cryptocurrencies. They seem to be irrationally oblivious about the risks of cryptocurrency trading. Consumer-related risks have therefore gained the attention of regulators around the world. MAS is considering further measures to reduce consumer harm. Adding frictions to retail access to cryptocurrencies is an area we are contemplating. These may include customer suitability tests and restricting the use of leverage and credit facilities for cryptocurrency trading. But banning retail access to cryptocurrencies is not likely to work. The cryptocurrency world is borderless. With just a mobile phone, Singaporeans have access to any number of crypto exchanges in the world and can buy or sell any number of cryptocurrencies. The cryptocurrency market is also fraught with risk of market manipulation. These risks include cornering and wash trades, actions that mislead and deceive market participants about prices or trading volumes. You see this in stock exchanges, you're seeing this in crypto exchanges. They compound the inherent volatility and speculative nature of cryptocurrencies and can severely harm consumers. There is greater impetus now among global regulators to enhance regulations in this space. MAS will also do so. But safeguarding consumers from harm requires a multi-pronged approach, not just MAS regulation. First, global cooperation is vital to minimize regulatory arbitrage. Cryptocurrency transactions can be conducted from anywhere around the world. MAS is actively involved in international regulatory reviews to enhance market integrity and customer protection in the digital asset space. Second, the industry has an important role in co-creating sensible measures to protect consumer interests. MAS has been sharing its concerns with the industry and inviting views on possible measures to minimize harm to consumers. And we will publicly consult on the proposals by October this year. Third, consumers must take responsibility and exercise judgment and caution. No amount of MAS regulation or global cooperation or industry safeguards will protect consumers from losses if their cryptocurrency holdings lose value. Next risk, stablecoins. Stablecoins can realize their potential only if there is confidence in their ability to maintain a stable value. Many stablecoins lack the ability to uphold the promise of stability in their value. Some of the assets backing these stablecoins, such as commercial papers, are exposed to credit risk, market risk, and liquidity risks. There are currently no international standards on the quality of reserve assets backing stablecoins. So globally, regulators are looking to impose requirements such as secure reserve backing and timely redemption at par. MAS will propose for consultation a regulatory approach for stablecoins in Singapore also by October this year. Finally, financial stability risks. Financial stability risks from digital asset activities are currently low but bear close monitoring. As the digital asset ecosystem grows, it will be natural for linkages between the traditional banking system and digital assets to grow. There is risk of contagion to financial markets through exposures of financial institutions to digital assets whose values may plummet. So MAS is working closely with other regulators to design a prudential framework for banks' exposure to digital assets. This framework will provide banks with clarity on how to measure the risks of their digital asset exposures and maintain adequate capital to address these risks. And this will reduce the risk of spillovers into the traditional banking system. Let me conclude. Singapore wants to be a hub for innovative and responsible digital asset activities that enhance efficiency and create economic value. The development strategy and regulatory approach for digital assets that I have described go hand in hand towards achieving this. Innovation and regulation are not incapable of coexisting. We do not split the difference by being less stringent in our regulation or being less facilitative in our innovation. No. MAS's development strategy makes Singapore one of the most conducive and facilitative jurisdictions for digital assets. We work closely with the industry. At the same time, MAS's evolving regulatory approach makes Singapore one of the most comprehensive in managing the risks of digital assets and among the strictest in areas like discouraging retail investments in cryptocurrencies. So I hope this presentation has made clear that MAS's facilitative posture on digital asset activities and restrictive stance on cryptocurrency speculation are not contradictory. It is in fact a synergistic and holistic approach to develop Singapore as an innovative and responsible global digital asset hub. So with that, I've come to the end of my remarks. I hope this has made matters clearer. I just thought I should add, there are lots of people from the media tuning in. There's a little discussion among my colleagues as to what the headlines will be. And I sympathize with the media because it is not easy to convey the complexities of the issues that I've just laid out, the benefits, the costs, the different aspects, the difference between cryptocurrencies and digital assets, and what we're talking about, what we're trying to achieve. But I leave it in your good hands. The title of the speech itself may be a headline, hint, hint, but it's really up to you. Really up to you, and we look forward to working closely with you. And we do need to explain this repeatedly to the public and to the industry so that we can get to where we want, harnessing the benefits and minimizing the risks. Thank you very much.
So thank you, MD, for clarifying and sharing MES's position. I think it certainly was a Finance 101 tutorial as well as a tutorial on digital assets. So, at the end of this year, we have the Singapore FinTech Festival in November. We'll be continuing the dialogue on digital assets, and there'll be many, many sessions and roundtables that will bring the public and the private sectors together, ultimately to advance and progress our industry. So get involved and join us in November. So while we wait to set up, I'd like to share a few reflections of a recent trip to Thailand for the event TechSource. So during the trip, I met with a large number of founders in the digital asset space, and there were two distinct types of founders. The first type, sadly, around about 30% of founders, which had a clear direction of the problem statements, customer needs, and a path to deliver. A great example of this was two unassuming founders who were building a business to connect freelance tech talent in Thailand to companies that had specific projects. The freelance talent will be able to store their credentials, projects that they completed, and references on the blockchain to make it easier to verify the projects and ultimately match with the company's needs. They had a clear path to monetization. They also were managed to reduce the friction and the time in the recruitment sector. The second group, which was quite sad, it was around 70%, seemed to be driven by making money and status. A kind of a feeling that the streets are still paved with gold and that they'd missed the boat in the previous gold rushes. And there was a great example of a founder who spoke at length about setting up a crypto exchange. And while he talked a good game, he couldn't answer the fundamental questions of what his competitive advantage was. He couldn't even answer the question around a clear path to monetization. And so, amidst the volatility and change in the market, clearly a surge in inflation and a significant downturn in growth, the need for critical thinking about your business model, what it will be or remains in terms of resilience, is clearly of paramount importance. And that's one of the reasons why this year at the Singapore FinTech Festival, we're going to be deconstructing the very essence of a resilient business model in today's market. Key stakeholders comprising of government leaders, regulators, financial services leaders, entrepreneurs, investors, and tech leaders will take stock of the drivers for change and critically examine three key areas: viability, responsibility, and inclusivity. So now we have a very special panel for you. We have a number of industry leaders that are going to be joining us, and I'd like to welcome Sopindu Mahanti, Chief FinTech Officer of the Monetary Authority of Singapore, as well as the rest of the panel. Please come to the stage.
Okay, music's done. Okay, MD Ravi Menon ended by saying headline. If you observe that second slide, almost 80% is my contribution of confusion and contradictions. So I hope this panel doesn't end up giving that to our dear media friends there, the headline you're looking for. And strangely, for the first time, I've done some homework before I do this panel, which is not my style. I realize that I'm a victim of giving wrong headlines. So I'll try my best to stay away from that, but still will give you real content and see how we go with this. I thought MD did a remarkable job in articulating what this is all about. But this slide, I'm not going to spend time explaining this slide, but there's only one message I want to give, that you cannot avoid cryptocurrency to make this work. Cryptocurrency is almost a necessity to grow this new asset class, because we are talking of a new form of money and a new form of assets, and both go together. As MD Ravi Menon spoke, that they operate under a particular internet framework, which is powered by the Web 3.0, DLT, smart contracts, and all this technology. And on top of that, we have AI, virtual reality, which makes this whole experience far more intuitive. And if an investor look at it, they look at every bucket, and they're putting billions of dollars to make it work. By latest report, we heard that close to 500,000 programmers are engaged in making it work. And banks, businesses have taken a piece of the technology and started improving the existing processes. We'll talk about it. But the regulators are concerned only one part of this whole thing, is the little thing on the side, the cryptocurrency, because that has taken a huge life of its own without serving the core need, is to promote the non-fungible asset or the assets which represent ownership in a different way. And that has taken a lot of time, a lot of distraction, a lot of media attention. So if there's one thing we should take away from this session, is that this is a much bigger play than what we think. And we have got extremely distracted with this little thing out there. But that doesn't mean that cryptocurrency doesn't have on its own life. But definitely it is part of the system. What I meant by cryptocurrency is actually privately backed coins. I think the whole thing is cryptocurrency. So I will start with the slide which actually questions the basic technology framework of this Web 3.0. So I have to talk about it representing technology. Alex, business, Carl, Rich from Paxos, and we have Umar joining us from US, from JP Morgan. And they'll all represent their own respective institution and express their interest and their thinking around this space. Okay, Alex, I'm going to start with you, because if this doesn't work, we can forget about this crypto business and this digital asset business. And there's this extensive congressional letter which was signed by really credible people, and they questioned the basic value of this technology. They questioned the technology itself in terms of its promises, and they questioned the security, the transparency, privacy. Almost they made it look like it's a bad idea. Defend it.
Okay, so I think, first of all, technology is very often about trade-offs, and I don't think blockchains are any different. So when people look at a blockchain and they think this is very slow, it costs a lot to make transactions, especially in certain parts of the market cycle, really that's because you're trading off some of that scalability for more decentralization or more security. And so this is a very basic and common framework to think about blockchains, that you have scalability, you have security, and then you have decentralization. So I think this is a very important concept to grasp, because it's not the case that you couldn't create, say, an Ethereum or another public blockchain that works faster, but that means you have to trade off some of these other aspects. And so that's one of the parts that they address in this letter, that it doesn't necessarily work, say, as fast as you would want it to work for consumers. Over the last few years, we've seen other blockchains, public blockchains, come to life, which make other trade-offs that maybe sacrifice some of the decentralization aspect in order to have more scalability and more throughput. So I think that's a very important concept to think of here. And there are other trade-offs that they talk about in this letter as well. So privacy is an aspect that they mention, which I think we'll talk a bit about later as well. Privacy, the flip side of that is transparency, right? And I think blockchains are quite unique because they do have, especially public blockchains, they have much more transparency than the current financial infrastructure. And so, we heard about Luna earlier, an example of, that's not something that you want to see happen, but the transparency of the blockchain allows you to actually dig into it and understand what happened days or weeks after it happened. If you compare that to the great financial crisis in 2008, think about how many doors you had to knock on just to get the information to understand what really happened. So I think that's another trade-off that you have to think about. And from a regulator's perspective, I think the transparency of blockchains is actually a huge benefit compared to trying to regulate the financial sector, which traditionally has been much more obscure and obfuscated. And you have to impose certain reporting requirements in order to improve that. So I would say transparency is a major benefit of blockchains, and it also gives consumers, users, investors a way to audit whatever it is that they are looking at. And so, I think we'll talk a bit more about that later, but we have some recent examples of, say, HODLNOT, for example, where it turns out that you could have a lot more you have a lot of transparency, and perhaps you could have looked even more into that as it was happening. And you might not be able to stop everything before it happens, but you're able to monitor what kind of transactions take place. If you see an entity that manages, say, $500 million worth of customer deposits, you'd probably want to know what they're doing with those assets. So it's not a black box. That's both from the regulator perspective, but also from the consumer's perspective. So I think there are a lot of benefits to blockchains that maybe most people are not aware of, but it's important to think about the trade-offs you're making when you talk about these different.
So Alex, I think that if I have to really take the three big issues still there: cost issue, it's still expensive to use this technology to build these assets. Second, I believe it has been resolved, the whole energy consumption part. And third, if you have heard Ravi Menon's speech, he never used the word blockchain. He kept on using DLT. There's certain dislike for the word blockchain.
Yes, yeah, you have some of these kind of euphemism almost, right? You could argue that, You could say perhaps DLT is somewhat of a euphemism of blockchains. I think there will be different opinions in the panel about that. Maybe digital assets are a euphemism for cryptocurrencies to some extent, or crypto assets rather. So yes, there is a lot of, you have to think about these things.
So they really doesn't matter whether you call DLT or blockchain.
I think some of it is literally just words. And you go to this specific audience, they will use these words because they happen to be more TradFi, traditional finance oriented. Another audience will be more crypto oriented. But really they're talking about
the business case which drives the definition.
Yeah.
Not the technology. Technology is still the same.
Well, the technology is not the same.
Okay.
Well, the technology is the same between the groups, but it's definitely different from traditional finance infrastructure and so on.
And the energy issue has been resolved?
It will, I'm not going to say it's going to be resolved, but in about 3 weeks, there's an upgrade from Ethereum to Ethereum 2.
The layer 2 coming.
Yes, exactly. And this will drastically reduce the energy consumption, which, by the way, I think is another point in this letter. They don't really talk about how you've had a lot of evolution and development within the blockchain space. It's not the case that, back in 2010, 11, you had Bitcoin, and that was pretty much it.
Sure.
You had Ethereum come along and address that, hey, maybe you want to create applications that can do anything, right? That's the major innovation from Ethereum compared to Bitcoin. And now we're seeing another innovation with regards to the consensus protocol, which can drastically reduce the energy consumption.
Last cost, very expensive still. It's still expensive than any other technology stack we have today. Perhaps when I come to the next question, it'll come there. Expensive technology.
Yeah, I think you have to compare it to the right benchmark. If I want to send US dollars from my bank account to a completely different country in the world, it can cost me quite a lot of money actually. And it's also slow, and there's about a 30% chance that the receiving bank doesn't acknowledge it and sends the money back while still claiming a fee. So I think you have to benchmark it in the right way. If I send stablecoins, for example, USDC or Paxos USD, that can cost me $1 or less.
So it'll be priced on the product benefit, and then the price will not be a big deal.
But it's about trade-offs, right?
Okay.
So if you have a centralized entity that allows you to make free transactions, then you're probably giving them you're trusting them.
Sure.
But if you want to trust the layer 1 most secure blockchain, it's going to cost you a little bit. Yes.
Okay, so what you're saying is getting fixed. 500,000 programmers are working very hard. We'll get there. Now we go to Carl. Now, you don't have a great history when I'll show the slide. Look at your friends. They're all losing their way. Actually, the last one is interesting. They just dropped DLT and went to cloud.
All right.
Why you are still engaged in this technology?
Well, it's a great question, and we get asked about it a lot, especially since some of this latest news. But I really think that the point is everyone's focused on the technology, right? If a business fails, is it the technology or is it the use case? And if you look at when Amazon started, did they start selling Kindles and ebooks in 1995? No. There were probably 100 ebooks available. That wasn't a market. They sold what people knew, hardbacks, paperbacks, to build a network. At Contour, I think we're different from some of these is because we've taken our first use case to build a network is letters of credit. It's been around for 400 years. What we're taking the same process of a letter of credit, that workflow, and we're digitizing it and putting it on DLT, blockchain DLT, however you want to talk about it later, but make it more efficient. It's 90% more efficient because we're connecting 4 players in the ecosystem. Now, what we're not doing is creating a new product. We're using the same legal framework that's been around since 19 years, since 2003. EUCP 600 has been around, so we're using the same legal framework. So we're not asking any customers, any banks, any corporates to opine. The bank risk managers have to decide on how this new product should be managed. The accountants have to decide on the accountant treatment. No, it's the same product, just more efficient. So I think the key thing is a product market fix is the first thing. I think the second thing is how we're different is that we're backed by, as MD mentioned before, we're backed by 9 global banks, some of the biggest trade finance banks in the world, HSBC, ING, BNP, Standard Chartered, SMBC. They want us to succeed, and they support not only by money, but by introducing customers, but also integrating us into their back offices so it can be better experience for their customers. We're not the fintech to steal their lunch. We're the fintech to help them digitize and help on the digital journey, which is going to take time. So we have that support. And I think the third thing, and again was mentioned earlier before, was inclusivity. Most of these systems, I mean, DLT blockchain is the way I describe it, and I'm not technical. It's a very elaborate, exquisite way of managing databases. It's much easier to put everything on a single database, right? The reason we use DLT, using R3's core to DLT, is that in this geopolitical world, data privacy, data residency, countries are saying, I want my data to sit in my country. I don't want a central database. And so we give the optionality. 95% of our customers use our SaaS model. We host their databases for them. But if they want to host it in their own cloud, on premises, in their own country, we give that optionality because that's what's needed, whether it's in Malaysia or Saudi Arabia or China. There's a lot of countries where data privacy issues are there. But the inclusivity part is really, blockchain is also, again, goes to what Alex was talking about, is it's an expensive way also of managing data. And I don't think a lot of these companies have found a way to make it efficient for the smallest players, at least on the B2B space, to use it. So we see most of the players are just selling to the biggest MNCs. Well, we've just created multi-identity, which allows us to have a low-cost offer to SMEs, MSMEs. So we have those small companies and the multinationals on the platform. We have the global banks, as well as regional, as well as local banks in developing countries. It's all efficient to join the platform. Global trade is big and small. It's not just one size only. And I think if we look at it, if we pull them all together, that's going to be a much better offering. And again, some of these companies came up with ideas that were maybe too far in the future. I think the fact that they're closing down does give some, I guess, two things. One is that there's going to be consolidation, obviously, in the market. We see some opportunities.
So this is a business problem, not a technology problem.
It's a business. We see some opportunities to consolidate the market and acquire some assets. But we also think that partnering is really important.
Sure.
Because global trade is very difficult. TradeFind is one part of it. There's got to be partnering, and whether that's on blockchain, on the same blockchain protocol, non-blockchain, APIs work pretty well. But I think partnering is also going to be the way to success.
So the one thing I take away from your explanation that because the global policies around data storage distributed, the technology has to follow that architecture. So it's very hard to take a traditional database and put it into a business model. So there's a business model and technology fit so that it works for you. Well, switching the gear, Rich, I need a slide for you. Okay, here goes. Too small, a lot of noise, and you saw MD's speech. He has perhaps 2/3 for you to think about your exchanges, how to make it better. And plus, 1 billion people already on the network. I mean, if I look by latest number, 1 billion people are in this world of crypto. And the market caps versus the market value, which is perhaps close to 100 billion, and the capitalization is close to at peak 3 and now down to 1 trillion. All this are going to get caught up in your infrastructure space. So, first thing, you saw what MD was trying to say, that you got to get more disciplined there. Share your view, because you hold the key to success of this Web 3.0. If you fail, I can trust me, this whole industry is going to collapse.
So there's a lot of pressure and a lot of fun.
Yes.
I guess to answer that question, I unfortunately would have to say things very generally that may not always be positive for the crypto trading industry. But
we're just going to give a headline to the media now. Continue.
So I think generally, so we're not per se exchange. Paxos is not, and we'll love to share a little bit. But just to answer the question, I think that the exchange industry tends to be an oligopoly. There really shouldn't be that many of them. And as Pat mentioned earlier, just before the session, he will meet new exchanges, and they don't really have a business model. And very sadly, the reality is a lot of good people want to start great businesses, but it's difficult to break into an industry when you're competing with very large players. And people who are starting off, they tend to generate revenue from listing fees and advertising fees of new tokens that may not be ideal for retail people to trade and may not be ideal for, anyone to trade without the right underlying technology. So if you skip past those people and you just consider, who really matters the most, say the top 3 to 5 global players without naming names. But I would say that there are a couple of issues that leads to higher speculation, higher price volatility, and I'll talk to some of them. I think the first one, like I mentioned, is listing standards. So historically, if you go to SGX, the NYSE, there are certain standards that you have to keep. In the crypto space, because a lot of them are newer technologies, they're essentially VC investments that get listed significantly too early. And people would choose listing them based on either preferences for protocols, preferences for certain types of companies to exist, instead of actual real solid standards, right? So I think that what we're seeing now, which I hope will continue through the industry, is that industry leaders are outwardly saying that whether or not you get listed should not be based on partnerships, protocols, or other interests. It should be based on the size of your user base, how well used your product is, how widely used your protocol is, and how useful you are to build the industry.
So can you repeat again, because this is the key. Because a lot of this coin, they don't talk about underlying product after a few months because the price has taken off.
Exactly.
So can you repeat again so that people understand what you should do?
So industry leaders in the space have very clearly stated that listing procedures should be based on user numbers and actual use cases of these protocols.
There you go.
And I think that is industry leaders should keep to that. I think the second thing is, and Andy mentioned this earlier, is the market makers and that interaction. And I think you mentioned wash trading earlier. I think it's a little bit more complicated than that because most exchanges work with all liquidity providers, but few have internally integrated or closely partnered liquidity providers. And what happens there is on the spot market side, it could be prone to front running, which is a little bit more dangerous and more harmful than wash trading. And on the future side, it could be significantly more dangerous because if you wouldn't know the asset sizes of your customers, they could be wiped out and taken out completely, and that would be very, very profitable for a very small number of people who have that information. So we've seen in the past that exchanges who provide futures products, they are very solidly clamped down. No one can know position sizes of anyone, and market makers and all that have to be very, very, very separated. And I think that should be a practice for the industry as a whole, that information must be on very severe lockdown, and there should be no preferred / integrated / whatever market makers working with exchanges. And to the point on futures, and I think this is something that led to what a lot of the worries about on speculation. So in 2017, during the ICO boom, the ICO craze, you guys remember then, one thing that made it very easy for that to happen was that people would list spot token along with perpetual futures contracts. And that led a lot of projects that weren't there for the long run, let's say. With very little money, you can pump up the value of a token to something very, very high. And then basically on the spot market, be able to sell it for cash. And that can be done with very little money because of the leverage that perpetual futures offer. So we still see a little bit today that major exchanges would concurrently list spot and concurrently list perps, perpetual futures. And that causes massive amounts of speculation. And I think that as a general practice, and industry leaders who provide futures products need to ensure that they have to be, that if they were to list the perps, it should be a mature product. It should be something that's traded everywhere. The project founders should go through extensive background checks, and of course, multi-year lockups on their tokens. Because one other thing that the perps do which leads a lot again to speculation, is that I may have a lockup on my holdings of these tokens. But if I pumped it up and I just sold short at the top, I don't really have to wait for the unlock of my tokens. I've essentially realized that value over time. And that, I think, is a very poor industry practice when exchanges list both spot and perps together.
Okay.
And I would say, I guess, the other thing, again, that leads to speculation, and I'd like to say that all this is not Paxos related. I'm just saying, telling the answer generally. But I think that most large exchanges generally have lending programs for margin loans, just like most brokers do. Customers have cash, customers have assets, and you can lend and you can borrow. And I think what we've seen through some of the exchanges is that there has been a series of interborrowings and capital that comes in significantly from outside the industry. What happens with that is that you are able to provide customers with excess leverage. You are able to get uncollateralized loans, which is very dangerous, not what typically happens at a brokerage for a margin loan. And within crypto, it's very difficult because it is very hard, it's very easy to rehypothecate assets. So the same assets can be pledged to multiple parties. Why? Because there's no official custodian, right? And I guess that leads to my last point, which I think is really important as well, and we've seen it and many reasons to want it, is that many funds in the space are new, and assets move very quickly and very fluidly. And because of that, most don't actually have a third-party custodian for fund assets. And that's when you get to the problem of, hey, where the fund assets go to, what movements were there, who was actually monitoring this. So, the need for a third-party custodian is always very important.
Sorry, go ahead.
I was going to say that having said all that, I would just like to clarify that at Paxos, what we actually do is crypto brokerage.
You do everything right.
We are not involved in that. We are a crypto brokerage company, and we are licensed by New York Department of Financial Services, MAS, of course, and federally in the US by the OCC. We only trade our own stablecoins and a very small select number of crypto assets that power technology, a very small number. And we power our partners like PayPal, like Interactive Brokers, like Mercado Libre, to offer this to their customers so their customers can gain access quickly.
Sure.
We route out orders to wherever has the best prices, and we ensure that it's all safe within our custody system.
Okay, good. And what you just said, that the number of listing in exchange will go down by perhaps 80%.
Yeah, you put me in the uncomfortable position of having to describe it, but that is part of the key reason why, and as MD Menon mentioned, market sentiment is it,
Yes,
but then
I
why market sentiment is higher is because of these dynamics.
Sure. Well, I think your points were quite valid because there is no speculation. It so happens that if you get this right and the listing goes down, be it, but in the long run, it is good for the industry. Well, now the last speaker for the first round is Umar from New York. The slide for you is this. Somehow regulators have boxed you to think only on applying technology, not to think about the other side, which is the asset side, but we'll come to that second round of questioning. Answer the first part of the question, which is banks have been really half-hearted when it comes to applying blockchain DLT in the use cases. Very little evidence we have seen where that technology being scaled and deployed in a production-grade environment. And we all know the T+3 problem is still out there, and we know this technology can solve all these issues. Please share your view, how we can embrace, sorry, I shouldn't say how we represent banks and more. How do we ensure that banks and FIs embrace this technology in the full strength to get the full benefit? Umar, all yours.
First of all, Ranu, thank you so much for letting me join via Zoom. I know it's not the easiest format, but thanks for accommodating. And I think I will also start by saying that what MD Menon said, I would and JP Morgan would fully agree with, actually point for point. And that's one of the reasons why we work so closely with our friends at the MAS for many years now. I think when it comes to deploying blockchain technology, you said banks have been hard-hearted. I would say all the banks have probably half the heart and JP Morgan has the other half. So, we have about half the heart of the industry right now. But I think from our point of view, it's a stepping stone. So yes, can we get into the asset side? Yes, and we'll come back to it. I know you said in a second question, but we at least remain very committed to the technology and heavily investing in the technology, because I think when you look at Web3 and you look at what the framework and what the runway of this thing can be one day, it would be quite short-sighted for financial institutions not to be very heavily involved in this technology. So if you think about everything from how money moves cross borders, and by the way, a side note there is I also run the business that moves about a quarter of the world's dollars on Swift. So I do have to correct one thing Alex said, which is it is not a 30% reject rate. I'm not saying that a P2P consumer payment is not expensive. It is expensive. But the reasons for expense are things like AML, KYC, last mile, transferability, et cetera. And I think once the regulatory arbitrage between the crypto industry and the TradFi industry kind of becomes smaller, I think that the delta is not going to be that big. But regardless, I think when you look at moving money, when you look at trading assets, and I mean, even the assets we all know well, like bonds and stocks and things like that, even before you get to things like tokenized real estate and whatnot. And when you think about the infrastructure of how these things work, I think if you look at the future, you can see how this thing can be dramatically different and how the entire infrastructure can be reinvented. And that's why, at least JP Morgan, we've been investing very, very heavily in thinking about not so much applying blockchain technology, but building the infrastructure that enables applying that technology to the assets as they are understood and regulated today, but also enabling us to be ready for the next cycle, which will be the asset cycle when other assets, whether again they are NFTs or other sorts of non-fungible type tokens, or even fungible tokens like different currencies being tokenized, that we are ready for that. And I think whether it's the JP Morgans of the world or frankly platforms like Partier, which are enabling similar technology in cross-border money movement, or even some of the stuff that's being proposed by our friends at other banks, including things like the Regulated Liabilities Network, not to leave other friends out of this discussion. All of the banks are looking at this as a way to really rethink the future of their business. So I think there is quite a bit of heart. I think it's obviously a little bit more complicated given our regulatory regime, and frankly, that's what makes us safe versus nascent technology and nascent industry. Probably also makes us a bit slower. But when we do something, we know that we check all the boxes, everything from sanction screening to AML, KYC, to fraud checks, et cetera, which makes it much safer for our customers, whether they be wholesale, which is primarily the case, or even one-day retail. I think they will probably come to us because, I know we are all trying to build trust, and one of the institutions they trust the most, for better or for worse, is their bank.
So, Omar, you are still saying that for you to apply this DLT technology has a regulatory friction. Is that what you're saying?
Significant. I think there's significant regulatory friction, but in my mind, I think there's two things to keep in mind. One is, if something goes wrong at a bank, there is a significant implication for the industry, for the economy, for financial stability, and for regulators. So I actually don't think a higher amount of friction is unjustified. I do think there's a regulatory arbitrage which should shrink, but I think the regulators need to be pretty careful because at the end of the day, banks have things like partial reserving. That's why we have capital requirements. So I'm not actually against the friction per se. I think the delta a little bit is in terms of knowledge, which is you have a whole bit of industry that's just frankly not regulated at all and can do whatever they want. And then we have our side, and I think in many cases, and I think frankly the MAS is a bit of an oddball compared to most of the regulators, where I think your expertise in this field are quite advanced. But a lot of the regulators across the world are just not at that point yet. So I think it's a learning process for them as well. But I wouldn't say that it's unjustified. I think it's justified. I just hope everyone gets educated much more quickly and we can get up to speed.
So we still have a way to reduce the friction. Is there still a space?
Yes.
Okay, good. So
yes.
I'm sure we're doing a lot of projects to get that friction down. You look at one round of question, we're almost on the time. So let's go to the second round of question. I'm going to get back to the slide. Let's see if this allow. Okay. Okay. Here. Okay. Now the second round of question is going to focus only on the assets, because we should not forget the Web 3.0 has got these products, the fungible, non-fungible assets. Keep aside the tech capabilities. We spoke about it, you spoke about it, Umar spoke about it, and a lot of tech application. Let's now focus on second round on these assets, because that's the future of internet. That's where everybody will head to. And the kind of assets the future will start having are those two assets. Now, Alex, the problem regulators have today, once this asset reaches certain scale, very hard to regulate them. They're decentralized. They are not that transparent sometimes. So do you have an answer to that from a technology standpoint, so the regulators get comfortable as those asset class grows dramatically? And that will grow. That's the future.
Yeah. I think you have to slice the world in a few different ways. First of all, it's important to think about decentralized protocols.
Yes.
So examples would be Uniswap, Compound, Aave. These are protocols that manage billions of dollars, and they're smart contract-based, open source, right? On the other hand, you have what you could call crypto businesses. And so these are run by human beings. They're incorporated, for example, in Singapore, but they are not typically open source, and they don't have the same extent of auditability in real time. And so there are a few different ways that you can think about these two categories. The first one is that maybe the good part of the decentralized protocols from a regular perspective is that they are auditable in real time. You can see everything that happens.
Which is both assets.
Yes, yeah, for both assets. The other category, however, these are not auditable, but you can enforce regulation on them, right? So you can say, you're not allowed to do this, we will intervene if you do it, whereas a protocol runs
But this is outside the margin.
Exactly. So from a regular perspective, I think you have to accept that you have to regulate at the edges of the ecosystem. So, and by that, what I mean is think about the traditional finance, fiat-based world, which is kind of at the outer circle. And then the inner circle would be the, say, a public blockchain, right? So you typically could regulate when you go from the outside into that ecosystem. Once you're in the ecosystem, it's very hard to enforce. But I think it's extremely important to recognize that you can still monitor and audit to see what's going on. And so there are some interesting cases, like I mentioned earlier, with the case of HODLNOT and a few other entities, where you cannot get full insight into what they're doing, but you can see what happens on the chain.
I see.
Right? So that's very, very important. And sometimes that can allow you to perhaps intervene, which I think is important. So you have to think about that from the perspective of these two worlds, and these assets typically will be transacted and you will use them on both types of platforms.
Smart contracts, automated, autonomous organization, very complex. How do you regulate these smart contracts?
It's hard, right? I think Project Guardian is interesting because you might have kind of a separate ecosystem that has more of a permissioned ecosystem where you could allow for smart contracts to happen, but perhaps there's more control with regards to who can participate in that ecosystem. I would say, though, it's a shame. Like, I don't think anyone would benefit really if you block or try to ban the permissionless and public use of blockchains, because so much of the innovation happens there. That's where you have this permissionless innovation.
Then you are bringing censorship now.
Yeah, that's one way to think about it.
But then that's not what they want.
No.
Yeah.
We don't want censorship. Like, I mean, that depends. It depends on your from what perspective.
Okay.
But I do think it's very important to be thoughtful. It's not black or white. I think that was also MD's point earlier, that you have to have nuance. Sometimes that's hard to communicate if you just want the headline.
Yeah.
But these things can coexist, right? You can have permissioned ecosystems. You can have permissionless ecosystem. And very often, almost by definition, the permissionless ecosystems will stay ahead of the permissioned ones because of permissionless innovation.
Sure.
And they can build on top of other platforms, right? You can take Uniswap, you can integrate that into something without asking Uniswap for permission, and just issue a smart contract. So it's hard to enforce regulation, but you have full auditability.
Okay.
The enforcement, I think, typically has to happen either in permissioned ecosystems or at the edges.
Outside, so what can go into the system? What kind of product you allow? not on the program itself.
Yeah.
Inside this. Okay. Well, it is going to be.
Can I just give one suggestion?
Yes, please.
Because I do think that I haven't seen this before when it comes to issuing licenses.
Okay.
I think one suggestion I have here is if you're going to issue a license to an exchange in Singapore, why don't you ask them to disclose every blockchain address that they control, that they manage? It's a very simple suggestion.
I can
and
take
maybe a bit controversial.
I can take a quick poll. Who agrees with this? No comment.
For exchanges, lending platforms, and so on, I think it would be good for consumers. It would be good for regulators to have oversight.
Okay.
And it's not a big regulatory, or it's not a reporting burden.
Okay.
That's important, right? Because with traditional finance, you might have to spin up a whole team that does a lot of reporting. Here, you're just giving the blockchain addresses to the regulators. Let them look at it.
I didn't want to start the Tornado Cash issue now because it talks to this thing. Well, Carl, in your business, you can actually start thinking about converting some of the asset to this non-fungible assets. Why you have not done till now?
It's actually, we're doing it right now, right? I
You're doing
you
right
say
now?
We're taking the workflow of a letter of credit and digitizing it. That's really a smart contract, right? We're creating a digital LC. Is that a digital trade asset? Yes, it is. Is that tokenization of an LC? Yeah, you could say that, right? We're already there. We're already leveraging the technology. Now, from a bank and financial, institute's perspective, that's a little bit scary, right? So we stick to, we're digitizing digital journey, right? But we are using smart contracts in our permission ledger and creating digital trade assets, which they're already beginning to ask us to how can we exchange those, how we can build distribution, automated distribution, in the future among our ecosystem. We're in 18 banks in 51 countries. There's an ecosystem there that we can leverage for not only the products we're making now, but future products like open account.
So what cryptocurrency I need to have to buy those?
That's a great. Right now, it's fiat, right? Because we're working with the banks. In the future, do you want to have an atomic swap and connect it to crypto? Sure, right? But again, right now we're using the bank's products.
I see.
And digitizing them. When they decide to take it to the next level, atomic swap or whatever, that's very possible. And I think that's the partnership part of it, right? That we're on one blockchain, on Corda blockchain. How you connect to other blockchains, how you connect through APIs, non-blockchain, how you connect to the crypto world there's a lot of future products that are going to be built with the technology that we have now, right? If you have milestones, you can do dynamic risk financing. There's all these things I tried to do 20 years ago when in the dot-com days at another startup, right? Now we have the ability to take this information and help the banks, the way I said it, develop more products to delight their customers because they have a lot more data.
Sure. We'll come to this in a closed door, whether we need whether we need to have fiat to do this thing, but that's for closed door, okay? Not for this open discussion. Rich, you are a big supporter of a part of this fungible product, stablecoins. You believe that will really facilitate the whole growth of the non-fungible asset class. Defend, argue for that stablecoin.
Right. So, I think
Ravi Menon spent a lot of time explaining how good stablecoin is. I don't know. That's the headline, but there's a hope there.
I think, as MD Menon refers to it as atomic trade, atomic swaps, we always call it DVP. And the greater core mission of Paxos is to achieve DVP throughout the financial system, reduce balance sheet sizes, and create a ton of transparency throughout complicated financial balance sheets. So the stablecoin element is what we believe has to be traded against almost any and everything else. So before getting to the stablecoins, I would also say that we think about it on the other side too. So we have a product called Pax Gold, which is the largest digitized gold product out there. It trades 24/7, unlike the London markets. It's significantly cheaper to hold as opposed to gold ETF. More importantly, it's allocated and it's transferable for physical gold. So we think that there are a lot of product features that make it more interesting than trading unallocated gold OTC. right? So we think in the future we can have that swap against a stablecoin and create an atomic transaction. The other thing is our securities business line. The SEC provided us a no-action letter about 2 years ago to trial settling US equities outside of the DTCC since the formation of the DTCC. And that will allow us to clear and settle US equities significantly faster. So when you think about what happened with GameStop last year, you think about the front-end innovations that the technology industry has created, the financial industry has created. You know, we're trading in milliseconds on the front end, but we're taking a very long time to clear and settle on the back end. And so, you know, we think that that would be a very, very big push throughout the securities industry. So in order for those two things to happen, basically trading gold, securities, commodities, any commodity really, and any security really, for atomic settlements, you need a trusted cash counterparty. So our journey to creating our stablecoin started a very long time ago, where we approached our regulator NYDFS and worked with them for over a 2-year period to craft the specific sets of rules and policies that would make our stablecoin safe. And today we have about $20 billion in stablecoin assets. We are a white label B2B stablecoin provider, so we provide it for our customers. And we are only allowed to hold cash. And I think that's very important because there's been debates, and early on you mentioned how much should be in CP versus anything else. We don't have that option because we are only allowed to hold it in cash and extremely short-dated US treasuries. So if there's a new framework where we can hold in high-yielding assets, please let us know. We'll love it. But those are the exact rules and policies that have been set that we're working with our regulators on. So of the top 3 stablecoins in the world, we are the only ones under that framework and with that specific set of rules and policies. I think the second thing that makes a stablecoin really stable is that you should not be taking counterparty risk of the issuer. So if you look at the top 3 stablecoins, you're essentially saying that because this company exists, they will eventually swap my dollar back. The way we are specifically structured is as a pass-through trust entity. So our New York Trust Bank license allows us to hold the cash on behalf of the actual token holders. So essentially, our stablecoin is entirely bankruptcy remote. And so I think those two are important constructs of what we believe is stable. So as we get to try to achieve the highest level of stablecoins and work towards commodities, securities, and potentially other assets that we could create atomic swaps and DVP payments against, I think that's really important. And the little thing to add to that, what you said earlier about the various levels of permissions, I think that gets to be very product specific. So on the stablecoin side, and this again is not popular like you said, but due to regulatory reasons, we have specific rules in which under circumstances, anti-money laundering, anti-terrorism, these are our key priorities. Under those circumstances, we are able to freeze and burn wallets that have a whole lot of stablecoins.
But Umar just made an argument, if you apply all the rules, the product might be that attractive as a bank's payment process, but I'll not debate now.
The goal is DVP as opposed to ultimate. So there are balances, right? And I think for the security side, because the participants tend to be brokers, it shouldn't entirely be a completely decentralized chain.
Sure.
So as we work with different products and different customers, there are ranges of decentralization, and we are comfortable working with those ranges.
Good. Well, Umar, over to you. This is where banks have not played any role. And there is some evolving thing around the tokenized deposit. And in many ways, tokenized deposit will compete against stablecoins. And you have a strong belief with the regulatory compliance you have gone through, you can actually make it a competitive product against stablecoins and privately issued currency. Please argue to that.
So I don't think it'll be competitive, Sapnandu. I think it'll be pretty much a winner. So I mean, I'll put it out there. I'll tell you why. I think when you think about moving major money. So I mean, we move just JP Morgan. We move about $10 trillion every night. So every 24 hours we move $10 trillion, give or take. And right now, with our JPM coin infrastructure, we do DVP upwards of about $1 billion a day. Again, that's probably, I don't know, maybe 1 billion times more than anyone else is doing.
So I think when you think about it, when we are doing that $1 billion, we are complying with all the rules that the 10 trillion complies with. And so all of our regulators across the world are, satisfied with the approach. If tokenized deposits or some such thing were to take off, yes, would there be stable coins? Of course, there'll be stable coins. Just like there's, all kinds. There's Grab Wallet in Singapore, and there's PayPal and Venmo and others in the US. Private options will always exist, but when it comes to serious transactions, it's like you have to do 100 million, 200 million, $1 billion a transaction. You are always going to look to a regulated financial institution, maybe JP Morgan, maybe Citi, maybe DBS, maybe Standard Chartered, maybe someone else, doesn't really matter. But you know that the government, the regulators, and the entire financial infrastructure stands behind them. So I think when it comes to seriously large transactions, and they haven't happened yet, we'll get there. Now, the two things that I think are slowing the financial industry down generally are, frankly, one, regulations are still not clear. So if you think about deposits, tokenized deposits do not exist in the world right now. I mean, they can exist, but it's almost like going back to the 1800s. So it's a bit of a back to the future in terms of what used to happen, and you're going back to that bearer instrument nature. And when you go to the bearer instrument, it does become more complicated because, as I think Alex was saying, you can regulate the edges, but when a transaction is happening within the blockchain, it's now transparent. So that actually creates more transparency. While that's a good thing, that would also be quite complicated. And what do you do if some token has touched a bad wallet on its way and finally find its way back? Do you freeze it when it touches the bad wallet? Do you not cash it out? I mean, there's a lot of, I think, very valid questions that need to be answered. So I think one is the regulation is not caught up. But the second thing is there's not that many use cases. Yes, I mean, can I, try to have tokenized deposits to trade crypto? Yes, I can. But who cares? I mean, most of crypto is still junk, actually. I mean, with the exception of, I would say, a few dozen tokens, everything else, as has been mentioned, is either noise or, frankly, it's just going to go away. So in my mind, the use cases haven't arisen fully, and the regulation hasn't caught up. And I think that's why you see financial industry in general being a little bit slow catching up. But when it does catch up, and whoever catches up, I'm not saying it's going to be us, could be anyone, but the large institutions who catch up to this are going to be absolute winners in the market.
So let me get this clear. So for you to really make a business out of a tokenized deposit, you need the market to mature, well regulated, especially on the non-fungible asset side, because you need that currency to trade something. That trade something doesn't exist today in a scaled way, and that's where
or even the fungible side, because you can imagine us having a fungible dollar and a fungible Singapore dollar and a fungible euro. So it may not be by a financial institution, it could be just FX transactions, but you need all those things to mature so you can actually do things with them. Right now, we're just not there yet. Most of the money that's being used in Web3 today in the current infrastructure is for speculative investments. And as you can imagine, the banks have learned their lesson in 2008-9 that's actually, if you go down that path, it's probably going to end badly.
Sure. When I get running out of time, because we'll have some post-follow-up debate here. Well, because we're running out of time, I need to do this. Each of you give a headline, what you like to see tomorrow newspaper. So, what you like to see in tomorrow's newspaper?
MAS reaffirms its ambition to be a leading blockchain hub in the world.
This is such a long one. They'll not clickbait it. Okay, clickbait.
Singapore to revolutionize DLT infrastructure for the world.
No clickbait. You.
Contour will power global trade.
You have no chance. Umar, these three guys have not given any clickbait to the media. Give one clickbait. Serious one.
Global regulators shockingly agree on a consistent regulatory framework on digital assets.
Okay, with that, we'll close this panel. Thanks to all my panelists. You have been extremely candid, and definitely what I think we should collectively take away, cryptocurrency is not going to go away. They're part of an ecosystem called Web 3.0, and this is a new, as Umar says, a new form of money, and that new form of money is used to buy and sell a new form of assets, which not for us, for our future. They're more interested than us. So We'll find a path to regulation to make it work, and this is a work in progress. So thanks, everybody, especially our online viewers, to stay connected. I'm sure you would have got something to take away. Thank you very much.
Thank you.
So thank you all for joining us today. I hope our leaders have given you something to reflect upon and influenced your thinking. I think at this point, I'd like to thank the thousands of people that have streamed in, have taken the time from around the world, and have a great week ahead. Clearly keep it real and keep building is the message from today.